POET Technologies is a Canadian photonics and optical interconnect company that designs and develops photonic integrated circuits, light sources, optical modules, and its optical interposer platform to enable high bandwidth, low latency connectivity in data centers, AI clusters, hyperscale computing, telecom networks, and beyond. Its core gamble is that the demand for optical links inside and between AI servers and between data center nodes will accelerate sharply, and that POET's architecture can capture a higher share of that value chain. In 2025, POET is operating in a high narrative environment. Lots of excitement about AI infrastructure, but also skepticism about execution, recurring revenue, and near-term financials. If you are evaluating POET as an investment, you should treat it as a speculative, high upside and high risk technology play, rather than a stable dividend or cash flow generator. Let's begin with the recent financials to understand where POET stands today. In the first quarter of 2025, POET reported revenue of about $166,000. That compares with just $8,710 in the same quarter a year earlier. So in percentage terms, that is a huge leap. But in absolute dollars, it remains very small. That Q1 also showed net income of $6.3 million, or about 8 cents per share. But that profit was largely driven by a non-cash fair value adjustment to derivative warrant liabilities, rather than strong operational earnings. This means the headline profit is somewhat illusory. Once you strip out that non-cash gain, the core operations were still at a loss. In the second quarter of 2025, the pattern reversed in a more concerning direction. POET disclosed non-recurring engineering and product revenue of about $268,469 for the quarter. However, the company posted a net loss of about $17.3 million, or negative 21 cents per share. A significant portion of that loss was driven by a non-cash loss of approximately $7.5 million tied to revaluation of derivative warrant liabilities. Operating cash flows were negative, about negative $7.7 million in Q2 compared to negative $4.5 million in the same period a year earlier. The company also missed estimates on both revenue and EPS. In short, the Q2 results highlight the risks of relying on sporadic engineering service work, extremely low product volume today, and the weight of financial non-cash accounting swings. Over the trailing 12 months, POET's revenue is still minute. Recent data from revenue tracking shows total revenue over that period of about $467,950, which is up over 300% year over year. That sounds impressive percentage-wise, but the absolute base is still very low. In Q2 alone, revenue of $268,000 suggests that even if growth continues, POET is many orders of magnitude away from stable commercial scale. The implied price-to-sales ratio is extremely stretched because market capitalization is large relative to its revenue today. One encouraging sign is that the company is active on the capital markets front. In May 2025, POET closed a US $30 million private placement to raise fresh capital. That capital is essential because the company is burning cash and must fund R&AMP.D, development of optical modules, scaling manufacturing, and operational overhead. The fresh capital offers runway, but it also introduces dilution risk. This is typical for companies in deep tech stages. At the 2025 annual general meeting in June, shareholders re-elected all 5 directors, with each receiving over 94% approval, and approved an amended Omnibus Equity Incentive Plan. That plan increases the number of awards available to about 17,771,000, representing 20% of the then 85 million common shares outstanding. That indicates management and the board want flexibility for equity compensation, but it also signals potential dilution ahead. The strong vote support signals alignment and continuity of governance, but governance strength alone does not guarantee technical execution. Strategically, POET's value proposition lies in several areas. First, its optical interposer architecture aims to integrate photonics, lasers, modulators, and drivers on a common platform, reducing cost, power, and footprint compared to discrete optical modules. If that integration works at scale, it could offer a competitive advantage. Second, POET seeks to pair its modules with AI, data center, and telecom network customers, capturing the wave of demand from AI cluster interconnects, high-speed data links, 800G, 1.6T, and beyond, and next-generation pluggable optics. Some of its press materials indicate it is targeting those higher speed lanes for optical engines and modules. Third, in the optics and photonics world, barriers to entry are high. Manufacturing, yield, optical alignment, packaging, reliability, thermal management, and component supply chain are notoriously difficult. That helps insulate well-executed IP incumbents. If POET can move from prototypes and engineering evaluations to repeatable product shipments, that would represent a key inflection. However, the challenges and risks are steep. First is product commercialization risk. The company currently earns most revenue from non-recurring engineering, custom engineering work, not stable product sales. That means revenue is volatile and dependent on project timing. That is a fragile business model and does not provide strong margin or scale leverage. Second is runway risk. Burning cash while revenue is tiny requires constant access to capital. If capital markets sour or dilution becomes too steep, investors could penalize the stock. Third is execution risk. Transitioning from design to reliable manufacturing for optical interposers and modules at scale is extremely hard. Yield issues, thermal drift, packaging defects, reliability testing, all are potential failure points. Fourth is competitive risk. POET competes, or must compete, against established optical module, component and photonics players who have deep resources, scale and customer relationships. If POET cannot prove its differentiation quickly, it risks being squeezed or commoditized. Fifth is valuation risk. The current valuation, as implied by its market cap versus revenue, assumes an expected future of rapid adoption, margin expansion, and multiple re-rating. If adoption is slower or execution stumbles, valuation compression could be brutal. Finally, macro risk and capital allocation. If macro weakens, AI spending slows, or component supply chains are disrupted, demand for high-speed interconnects could be more muted than expected. From a technical and sentiment perspective, POET's stock is highly volatile. It is small cap and likely to be heavily influenced by news, press releases, funding announcements, strategic wins, or dilution triggers. Momentum swings are common in stocks at this stage. Some recent market headlines include POET launching a US $25 million offering, market reaction to that, and delisting from the TSX Venture in August 2025, a voluntary delisting to perhaps focus more fully on its NASDAQ listing. The company also announced collaborations and product milestones in optical connectivity and AI networking, which can trigger sentiment waves. These news events are often what move the stock more than fundamentals right now. To frame valuation and scenario outcomes, think of three paths. In a bull scenario, POET succeeds in converting engineering evaluation deals into stable product orders, scales manufacturing, improves yield, begins to generate tens or hundreds of millions in revenue within a few years, margins move positive, cash flow turns positive, and investors award multiple expansion. In that scenario, the equity could deliver multiples of return from current prices. In a base scenario, revenue grows steadily but remains modest for some time. Losses shrink, margins improve gradually, dilution is modest, and the stock drifts upward moderately. Returns are more muted but positive over a multi-year horizon if the optical interconnect wave holds. In a bear scenario, revenue growth disappoints, cash burn persists, dilution accelerates, execution problems bite, and investors lose confidence. In that case, the stock could decline materially or stagnate for years. Given the current profile, my view is that POET is a speculative high-risk, high-reward idea. It is not suitable for conservative portfolios or for investors seeking stable dividends or income. If you are a tech or deep tech believer and you want exposure to the Photonics AI infrastructure wave, POET is an interesting way to play that theme, but one should size the investment accordingly, assume high volatility, and monitor key metrics closely. Key metrics to watch each quarter include new product order bookings, transition from engineering revenue to product revenue, gross margins per module, yield and defect rates, cash burn and capital raise frequency, dilution, customer pipeline, and any strategic partnerships with hyperscalers or major optical or AI infrastructure players. If I were deploying capital, I might take a small starter position with a multi-year horizon, set clear stop or review triggers, and revisit whether to scale only after POET demonstrates consistent execution across product shipments and margin improvement. Do not assume overnight success. Deep hardware and photonics bets can take time to mature.